In the realm of personal finance, there is a pervasive misconception that saving money is a passive act. We are taught that as long as our capital is resting within a financial institution, it is secure. However, there is a silent force known as inflation that consistently erodes the purchasing power of idle currency. If your liquid assets are poorly distributed, you are essentially paying a hidden tax for that disorganization. Today, we will examine the three fundamental pillars of modern banking: the checking account, the traditional savings account, and the high-yield savings account. The checking account. The checking account serves as your central command center. Its primary function is not to facilitate growth, but to provide immediate liquidity and the seamless movement of funds. This is a destination for your primary income and the point of origin for your monthly obligations, mortgages, utilities, and daily expenditures. Because the institution prioritizes the accessibility of these funds, they rarely offer any meaningful interest. The sophisticated approach is to maintain exactly 1 month of living expenses supplemented by a small discretionary buffer. Any surplus beyond this threshold is dead capital. It is resting in a zero growth environment when it should be redirected toward an account that offers a return on your deposit. The traditional savings account. The traditional savings account at a physical brick-and-mortar bank often functions as a convenience trap. Interest rates at these institutions are frequently as low as 0.01%. To quantify that, a $10,000 deposit would yield a mere $1 over the course of an entire year. While these accounts are familiar, they fail to compete with the rising cost of living. In a modern portfolio, the traditional savings account should only be used for very minor, short-term goals that require instantaneous transfer to your checking account. For any significant reserve of wealth, this account is effectively obsolete. High yield. The high-yield savings account is the most vital tool for the modern saver. These accounts are predominantly offered by digital-first institutions that do not carry the overhead costs of physical branches. Consequently, they return that value to the depositor through significantly higher interest rates. These accounts offer annual percentage yields ranging between 4 and 5%. At that rate, that same $10,000 deposit earns $500 annually instead of $1. The strategic action plan. To optimize your finances, you must view your accounts as a tiered system. Your checking account manages immediate cash flow. Your traditional savings remains largely empty or reserved for minor immediate needs. Your high-yield savings houses your 6-month emergency reserve and capital allocated for future major purchases. If your savings are not currently earning at least 4%, you are leaving a significant portion of your wealth on the table.